Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I produced over 1,000 videos with more than 600,000 watch hours as of August 2025. I also focus on regional and global economic trends. If you're serious about taking your Singaporean investment journey to the next level, you'll want to hear this. Here's a common trap. Many Singapore investors chase the fattest dividend yield, 8%, 10%, then one day, dividend cut. Price tanks, portfolio in pain. Sound familiar? Here's the real fix. Focus on dividend engines that can pay and keep paying through cycles. Today, I've boiled this into 7 key points that can reshape how you build income in Singapore. These points come straight from real current data across SGX names. They're simple, practical, and tailored to how we invest here. Banks, SGX, CPF, SRS, and more. We'll cover how to structure your core, what to add for smoother cash flow, where the real risks hide, and how to use Singapore's tax setup to your advantage. Ready? Here are the 7 points we'll cover. Anchor your income on the big 3 banks, DBS, UOB, OCBC. Use SGX for quarterly cash flow smoothing. Add venture as a yield booster, but size it right. Keep Keppel small as your infrastructure play. Avoid unsustainable payout ratios. Singtel is a key warning. Leverage CPF/SRS advantages for tax efficiency and compounding. Build a real-world plan with position sizes, reinvestment, and a simple tracking system. Point 1. Anchor on the big 3 banks. Singapore's best starting point for dividend investors is simple. DBS, UOB, and OCBC. These banks pay attractive yields, backed by strong balance sheets and clear policies. Their payout ratios are generally within healthy ranges, which means they can keep paying even when the cycle turns. Think of them like HDB for your portfolio. Reliable, regulated, and built to last. In practice, this is your 60-70% foundation. Why so high? Because stability beats guesswork. When margins compress, these banks still have buffers. When rates shift, they adapt. And it's easy to monitor them. Track net interest margin and NIM and loan growth. Ask yourself, if your dividend income had to pay a month of bills, which stocks would you trust most? Point 2. Use SGX for quarterly cash flow smoothing. Not all cash flow lands at the same time. That's why SGX is useful. It pays quarterly and helps smooth your income through the year. Picture your dividends like a 4-room flat's monthly cash flow from renting a room. SGX is the tenant who pays on time every quarter. It won't be the highest yield, but it adds rhythm and reliability. A 15 to 20% allocation can help even out the lumpy payments from semi-annual payers like UOB and OCBC. This also helps with reinvestment. Regular cash lets you top up without waiting half a year. Point 3. Add venture as a yield booster. Size it 10 to 15%. Venture often offers a higher yield, backed by strong cash generation, but it's more cyclical. Think of it as the premium coffee. Great taste, but don't drink 5 cups a day. A 10-15% slice gives you a boost without letting one cyclical stock drive your income risk. What should you watch? Orders and end market demand. When electronics demand softens, earnings can wobble. That's why we size it, not spotlight it. Now that the core and the booster are set, let's pivot to the satellite position many investors ask about. Point 4. Keep Keppel small, with 5% as an infrastructure play. Keppel is better today than before in terms of dividend visibility, but it still rides the cycle. Projects, energy, infrastructure. Treat it like a small satellite in orbit around your core banks. If the cycle is kind, you enjoy the lift. If not, your core still does the heavy lifting. Keep it low to 5%. The metric to watch is project wins and execution. For even more detailed charts, deeper dives into the data, and a full written breakdown of today's topic, make sure to check out our Substack. The link is right there in the description. Point 5. Avoid unsustainable payout ratios. Singtel is a live case study. This is where many get trapped. A payout ratio over 100% means the company pays out more than it earns. That's like trying to fund your child's tuition using only credit cards. Works for a while, then the bill bites. Singtel's high payout ratio highlights the danger. The math doesn't work long term. Dividend cuts are not a surprise. They're a countdown. For income-focused beginners, this is not where you want your core money. Want yield? Get it from businesses that actually earn it. Point 6. Use CPF to SRS wisely. Tax efficiency and compounding. Here's where being a Singapore investor is an edge. Dividends from local stocks inside SRS are tax-deferred. No foreign withholding tax. Simple reporting. This makes bank stocks and SGX ideal SRS holdings. Imagine your dividends as a hawker stall's daily takings. Instead of spending them now, you keep rolling the earnings into more ingredients to sell more plates tomorrow. Over years, that compounding adds up. With quarterly payers like DBS and SGX, you also get regular top-ups for reinvestment, not just twice a year. Point 7. Turn strategy into action. Allocations, reinvestment, and tracking. Here's the blueprint. 60-70% across DBS, UOB, OCBC for your income bedrock. 15-20% SGX for quarterly smoothing. 10-15% venture for a quality tilted yield boost. 0.5% Keppel as your infrastructure satellite. Avoid Singtel until the payout discipline is fixed. Next, turn on automatic dividend reinvestment where it's available. This is your set and compound mode. Then, review quarterly, not daily. Dividend investing is like training for IPPT. You don't get results by checking your abs every morning. You get there by sticking to a routine. Track one key metric per stock: banks, NAM and loan growth. SGX, trading volumes. Venture, order trends and end market demand. Keppel, project wins and execution. Singtel, if you insist to monitor, free cash flow above dividends. Smooth transitions and questions to consider. If your goal is $500 a year in passive income, which names get you there with the least drama? When rates fall, which businesses still have room to grow payouts without stretching? If you lost your stock app for 6 months, which holdings would let you sleep well? Iggy's personal take: I rank the big 3 banks as the most important dividend engines for Singapore investors today. They combine sustainable payouts, strong capital, and simple tracking. If you're building income for the next decade, start there. My actionable advice: accumulate on dips and keep your bank weight high. Add SGX to smooth cash flow and help reinvest on a schedule. Keep venture sized. Don't let a cyclical name decide your income. Keep Keppel small. Let the cycle work for you, not against you. Skip unsustainable payers until free cash flow improves for real. For those using SRS, hold local dividend names there. Reinvest. Let tax deferral help compounding. If you have CPF-OA funds and you're considering T-bills or SSBs as your cash layer, see this equity income plan as the next layer above. Still disciplined, but with growth options. In a world where global narratives swing every week, this setup gives you control, clarity, and cash flow. So, we've broken down a simple, Singapore-focused dividend plan, and I've given you my personal take on how it applies to your journey here in Singapore. Build your core with the banks, smooth it with SGX, boost with venture, keep Keppel small, and avoid payout traps. Reinvest, review quarterly, track one metric per stock. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $3 a month, about the price of a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today.